You can't put a paper contract into into technology. You can't put a paper contract into a medicinal use. It has to be the real metal, and the problem is they can't print it. And that's where the severe shortage is showing right now, and that's where it's going to break, is in silver, not gold. Gold will follow. And if there was no such thing as silver, gold would ultimately break on its own, but silver is going to be the blasting cap.
Is where we are, to just repeat, I talked about the run to gold before anyone talked about the run to gold. And I said, look, I know it's happening because the smart money is getting in a stealth manner, which was the banks. And they were buying gold at a rapid rate between 24 and 25, and then we started to take off. And I gave the analogy that it starts like a light, a very light walk, then a brisk walk, then a light jog, a full jog, a light run, a full run, and an all-out sprint.
Yeah, this is, first and foremost, it's important to understand that gold and silver don't change. They don't go up and down. An ounce is an ounce. An ounce today is an ounce 100 years ago and will be an ounce 100 years from now. What's changing are the currencies. And I believe what you're looking at right now is this is the end of the fiat experiment. You're watching currencies devalue. I mean, if you have something go up 100%, it means if you've got silver or gold, it goes up 100%. That's a devaluation of 50% of the currency. And that's what you're watching worldwide, is that all currencies worldwide are devaluing. And these are not traders coming in. These are buyers that are cash and carry. They're buying a metal, they're having it delivered to them because they understand that the currencies are devaluing and they're ultimately going to devalue to zero. So you either have gold, you either have silver, or you're not going to have wealth when this is all done.
For decades, gold and silver behaved more like industrial commodities than money. Prices moved in short bursts, quickly restrained by market mechanisms and policy interventions. That pattern is now breaking. Metals are beginning to reclaim their historical role as monetary anchors. This transition doesn't happen overnight. It accelerates near the end of a cycle. While currencies still function, trust in them is fading. Central banks can delay the outcome, but they cannot prevent it. A reset likely comes before total collapse, but the direction is clear. What matters now is not price volatility, but whether individuals and institutions secure real assets before confidence disappears entirely.
Well, I think what's different is kind of what my main thesis was when I started on the web in 1999, meaning that the money metals would act as money in the, at some point in time. And really, they looked like industrial commodities for most of the year 2000 till recent months. There were some spikes there, but they were short-lived. So, they got out of the box or out of the cage and acted like money, but it was, again, a matter of weeks, and then they were under control again or under management. This time, there's no doubt that the end is nigh, as Bill said. Whether or not we get the 0 point or not remains to be determined. I mean, he's absolutely accurate. I've said for decades, all fiat fails. Three words that really portend the exact reason we're in the metals. However, I really think there'll be some type of a reset before it goes to absolute zero, but that's maybe a side issue. As far as the acceleration, yeah, this looks like what I expect near the end of a bull run. But since we've now switched from it's a commodity to if I don't have it, industry-wise can't do business without it. So it's not a matter of price. It could be $1,000. Why not be in position? In many industries, it's not a matter of how much does it cost me. It's just going to cost me my business. So I need X amount of ounces. So these businesses are thinking in terms of how many ounces do I need for the next year or 2 years or 3 years? Oh, and what do we look forward to? We're going to build out AI centers. We're going to build out this many data centers. We're going to do this much electric car production or whatever. Let's look ahead. Oh, I need our current supply of silver plus 20% going out 3 years, whatever it is. So there's that part of it. On the currency crisis side, as Bill said, it becomes a worldwide phenomenon where all currencies depreciate against a constant. That's that solid ounce of silver, that solid ounce of gold. And just to reiterate what Bill said, when you see that acceleration where it's saying your currency's dropped in half in 1 year, it's a wake-up call. And, as harsh as that may sound to the general public that doesn't understand how these fiat systems lose control, they see it in the grocery store. I don't know what the official number is, 17%. I know it's BS because I grocery shop, and I know it's probably, I would say, doubled. Some products have. Point being that people are seeing the emperor with no clothes. The game is over. The jig is up. The finance ministers on high are going to do their best to manipulate interest rates and try to spur something that never works, printing their way out of this thing. And so the currencies are devaluing because game's over, really. I mean, it's not over like tomorrow and everything burns to the ground. But as far as the ability for these guys to gain control back again, it doesn't look like it'll take place.
A major shift is unfolding beneath the surface. Industries are no longer asking what silver costs, they're asking how much they can secure. From artificial intelligence data centers to electric vehicles and renewable infrastructure, future production depends on guaranteed metal supply. Businesses plan in ounces, not dollars, locking in physical inventory years ahead. Unlike currency, metal cannot be created at will. Silver, in particular, faces growing strain as industrial demand collides with limited supply. This changes market behavior fundamentally. When supply security becomes critical, price becomes secondary, and shortages accelerate far faster than traditional market models predict.
There's no question they will try to monetize everything. The problem is investors sensing monetization are just going to dump treasuries. I've talked about this several times before, that if you look at the last easing cycle, rates went higher, market rates went higher. And here we are again, they're starting to cut again. And where are rates? Rates are slightly higher than where they cut rates a couple weeks ago. So it's the Fed losing control of the yield curve. And that's a problem. You have to understand that the reason gold and silver have been suppressed for all this time is because the U.S. Treasury had to be able to borrow basically unlimited amounts of money. And that's what this game is all about. There's mathematically, they have to monetize, and mathematically it won't work. The money doesn't exist to pay the debt back and to pay the debt service. So what do they have to do? They've got to print more. And when they print more, that dilutes what's in existence. And they will dilute to oblivion.
Yeah, more and more they will print to keep the game going. And as far as like another Operation Twist where they play with the long end and try to get interest rates to be quote unquote normal, yeah, that's a possibility. I've thought about that. They'll probably try it, but they're at the end of the rope because no matter how much printing or buying they buy, basically the rest of the world is fed up with our dollar dominance, and that means the buyer of last resort is the Fed. So they are going to print until the market wakes up and says, wait a minute, this currency is worthless. Now, again, I want to be on record that I don't think it's going to absolute zero, but the perception that it's getting there quickly is already in play, and there'll be more and more momentum in that mean. And as that takes hold, you may see much further acceleration than we've already seen in these metals. I mean, for an example, if we doubled this year for round numbers in silver and platinum market, maybe they'll go up threefold next year. I'm not predicting that. I'm just trying to give you the idea of when we hit that panic manic phase. This will look like a light run. When it becomes an all-out sprint, you're really going to see fireworks. And I think we've probably got another year or so to maybe where the new system comes in, the digital euro, the Amero, who knows? I mean, I think I don't know the exact number. I think it's 190 countries in the world, like 163 are making digital currencies. What does that tell you?
As governments respond to slowing growth with rate cuts and monetary stimulus, bond markets are reacting in the opposite direction. Yields rise instead of falling, a sign that central banks are losing control. Debt levels are now mathematically unpayable without currency debasement. Printing becomes the only option, and printing destroys trust. Investors sense this and exit government bonds, forcing central banks to become buyers of last resort. The suppression of gold and silver depended on stable borrowing markets. As that stability fractures, metals reflect reality. Inflation numbers understate lived experience, and the public is increasingly aware the system no longer works as advertised.
The metals have run big time, but all you have to do is look at a chart. I mean, you could look at you could have been a German in 1920 and said, the price of gold and the price of silver is crazy. But what happened 3 years later? And one thing that very few people are talking about, and people used to talk about quite a bit, was derivatives. The problem with the system today is that everything is financialized, everything is derivatized. And I mean, you're talking about over $2 quadrillion worth of derivatives. And all you have to do is get one market that goes offside, and that'll spill over to all markets. And I have posited for at least 10 years that I thought, because silver is the smallest market and the most suppressed, it's my thought that silver is the fuse to the derivative time bomb. I think silver's going to fail to deliver first. That'll spill over to gold the same day or the next day. And within 72 hours, markets will be completely dysfunctional, if they're even open.
Both, but primarily it is the retail market's mostly selling back. I mean, I talk with a lot of the major dealers and wholesalers, and they're stocking inventory, and they've got to finance it. I mean, if I have to make a market in the metals, I might have, my bank account might be, 5 million, but I've got to buy up 25 million in product. I got to finance that. So I got to buy it and maybe below spot or whatever, but then I still have to finance that. I got to borrow the money from the bank to make that market. And the longer I got to hold that metal on the shelf, the more it costs me. So I'm willing to lower my premiums to move the metal so I don't have the financing charges. So that's one side of the market. The big people, yeah, they're coming in. These are, I've never bought gold before, David. What do? I don't want to make a rookie mistake. And of course, I set them up. But the insatiable demands coming from India and China primarily, and this is mostly industrial demand, although in Hong Kong, if you look at this King Kong 888, I think it is, Eric Young, he's showing you that a lot of wealthy Asians are coming in and buying, I won't say boatloads of silver, but substantial amounts. North America, net sellers. Asia, net buyers. Primarily, I would say the industrial side.
Modern markets are dominated by financial derivatives, claims layered on top of claims. The notional value is vast, and stability depends on confidence. Silver, the smallest and most constrained metal market, may be the breaking point. If physical delivery fails, the consequences ripple instantly into gold and beyond. Unlike paper contracts, industry requires real metal. Asia understands this well. China and India demand physical ownership, not promises. While Western retail investors often sell to survive economic stress, Eastern buyers accumulate quietly. This imbalance exposes a dangerous truth. Paper markets can expand infinitely, but physical supply cannot. And silver is where that contradiction becomes visible first.
You're definitely seeing selling in North America. Retail is definitely selling. You've seen, I think what you're looking at is the economy is nowhere near as good as the official government statistics. There's no money on the streets, and people are raising money by liquidating metal just to live. Prior to, let's say, 2005, the United States was the game. But now it's the entire world, and the United States is not it's not leading as far as purchasing gold and silver. you're seeing massive demand out of Asia, and Asia, those people are cash and carry. Americans accepted, a contract for this, a contract for that, as good as gold, so to speak. But that's not the case. What we're looking at now is you've got Indians, you've got the Chinese. When they buy, they want the metal, and the problem is you can't print the metal. The metal doesn't exist. The real shortage is in silver. I mean, gold is considered money. Silver is not primarily considered money. The demand for silver comes from so many different industries, and it is cash and carry. I mean, you can't put a paper contract into technology. You can't put a paper contract into a medicinal use. It has to be the real metal, and the problem is they can't print it. And that's where the severe shortage is showing right now, and that's where it's going to break, is in silver, not gold. Gold will follow. And if there was no such thing as silver, gold would ultimately break on its own, but silver is going to be the blasting cap.
Bull markets do not rise in straight lines. They accelerate. What begins as a steady climb can quickly turn into a sprint driven by panic and scarcity. Many expect a decade-long bull run, but systems under stress rarely move slowly at the end. Governments are racing toward digital currencies, with most nations now developing central bank digital money. This shift signals preparation for systemic change, not stability. Precious metals threaten centralized control by existing outside digital frameworks. As volatility increases, delivery failures and market disruptions become more likely. Whether through reset or rupture, the current system is nearing its limit, and metals are signaling that loudly.
As far as where we are, to repeat, I talked about the run to gold before anyone talked about the run to gold. And I said, look, I know it's happening because the smart money is getting in a stealth manner, which was the banks. And they were buying gold at a rapid rate between 24 and 25. And then we started to take off. And I gave the analogy that it starts like a light, a very light walk, then a brisk walk, then a light jog, full jog, a light run, a full run, and an all-out sprint. And that's a metaphor for how fast this market moves to the upside. And as I said before, I think we're in maybe the light run right now, and we're far from the all-out sprint. I don't know if we're far from it. I mean, maybe, we go limit up 4 days in a row and the exchange is closed because, there's chaos. People aren't getting delivery, as Bill indicated, and, game over. I'm not predicting that. What I'm saying is we have a very volatile market. No one knows how much real demand can be filled by real metal. That's the key, as Bill has said. And so, yeah, I'm in total agreement. And I don't think we have a long ways to go. There's my peer group, many are saying, oh, we got a 10-year bull market in silver from this point on. In theory, we do. But in reality, no, because the financial system needs to be, or the powers that be, powers shouldn't be, want this thing to continue in their paradigm, which means total control with a digital-based cashless society. And they want to move to that before these metals wreak havoc with their current financial system.